am Sangeetha, Assistant Professor, PG and Research Department of Commerce CA, Kamadhenu Arts and Science College, Satyamangalam. Today I am going to taught you about the management accounting subject. In that we are going to see about the working capital. First of all, what is meant by working capital? The capital required for the purchase of raw materials and for meeting day-to-day expenditures of the business. It may be salaries, wages, rent and advertising, etc. So, capital required for meeting their day-to-day expenses is called working capital. Next one is the various types of working capital. The various types of working capital are: number 1, gross working capital; second one, net working capital; permanent working capital; temporary working capital; regular working capital; reserves margin working capital; seasonal working capital; special working capital. Now we are going to see about these various types of working capital in brief. First one is net working capital. Net working capital is nothing but the difference between the current assets and current liabilities of the organization. Next one is gross working capital. Gross working capital is nothing but the total value of current assets. Current assets in the sense receivables, inventories, cash, marketable securities, short-term investment and any other current assets is the gross working capital. And the third one is permanent working capital, a minimum level of current assets which is continuously required by a firm to carry on its business operations is referred to as permanent or fixed working capital. And the next concept is temporary working capital, the extra working capital needed to support the changing production and sales activities of the firm is referred to as temporary working capital. And the next thing is regular working capital, the amount needed to keep the operations in continuity. It refers to excess of current assets over current liabilities, so that the process of conversion of cash into stock into sales, receivables and collections is maintained without any break. And the next thing is reserve working capital. Reserve working capital, on the other hand, typically refers to any additional amount of working capital that a company sets aside or maintains a buffer to handle any unexpected or unforeseen financial challenges. Next one is seasonal working capital. The capital required to meet the seasonal demands of the enterprise is called seasonal working capital. For example, manufacturing of woolen textiles, refrigerators or coolers may need extra funds to carry on production and to accumulate stock before the sales operations. Seasonal working capital begin of short-term nature. It has to be financed from short-term sources like bank loans and financial institutions, etc., commercial banks, etc. And next thing is special working capital. All business enterprises have to prepare to meet unforeseen risk that may arise in the course of operations. These should have extra funds at unstated period to meet contingencies, funds needed to finance marketing campaigns, unforeseen events like accidental fires, floods, etc. Next one is advantages or importance of working capital. Why this working capital is important in every organization means we have to continue our production without any stoppage, solvency and goodwill of the organization easy availability of loans, cash discount from our creditors, regular payments of expenses, exploitation of market conditions. And there will be an excess capital. If an organization have excess working capital, means what are all the drawbacks, what are the problems we are going to face, means excessive working capital means an ideal funds which earn no profit for the business. Due to low rate of return on investment, the value of shares may also fall. It may lead to unnecessary purchasing and accumulation of inventories. It is an indication of excessive debtors and defective credit policies. Disadvantages of inadequate working capital. If an organization has inadequate or insufficient working capital, a concern cannot pay its short-term liabilities in time. It loses its reputation and faces tight credit terms. It cannot buy its requirements in bulk and take advantage of cash discounts. The concern will face difficulties in meeting its day-to-day expenses. This leads to inefficiency, increase in cost, and reduction in profits. Fixed assets are not effectively utilized. Thus, the rate of return on investment also falls due to this inadequate working capital. Next thing is importance of working capital. Why this working capital is very important in every organization means, first one is bill payment. Sufficient working capital enables the company to pay its bills, to meet the daily expenses, to make the routine purchases as and when required. Second one is solvency. It ensures solvency of the firm. Continuing production and sales would generate funds to meet their day-to-day expenses, and hence availability of liquid funds brings to the firms a touch of doubtless solvency and strength. Third one is the creditworthiness. The creditworthiness of the company is rated high if its working capital is found satisfactory. Credit status depends on the ability to pay and the promptness with which payments are paid in time. Fourth one is more credit facility. A company with sound working capital arrangements have high rated credit standings will be able to procure credit from commercial banks on easy or competitive terms. And the next thing is cash discount. A company having sufficient funds will be able to take advantage of cash discounts offered by its suppliers, raw materials or other merchants from prompt payments. Sixth one is high morale of employee. Regular payment of wages, salaries by a company with the working capital maintains and enhances morale among the personnel, and efficient performance can be secured thereby. Seventh one is business cycles. A company having strong finances can successfully weather the storms at business cycles. In depression, there would be pressure or working funds. Hence, a company having sufficient cash reserves will be able to ride over the dark phases at a slump and recession period. Boom period. In times of boom, when there is rush of orders, companies having adequate working capital can execute the routine as well as special traders by purchasing additional raw materials and employing additional staff. Higher prices of products. Companies having sufficient working funds can wait for better marketing opportunities by holding up inventories and secure high prices. Otherwise, hasty sales by companies with short funds would lower their bargaining power in the competition. And the next thing is self confidence. Continuing prosperity and progress at the undertaking can be maintained by ample working capital. Managers themselves will get self confidence and can infuse such confidence among the other levels of administration. Next concept is fund flow statement. The fund flow statement is a report on the movement of funds or working capital. It explains how the working capital is raised and used during an accounting period. I think now you all are clear about the concept of working capital. Thank you.